everybody, welcome to a new video on RRG and relative strength, and this week also seasonality. My name is Julius de Kempenaer and I am the creator of Relative Rotation Graphs, and in this video I want to quickly talk you through what's happening in sector rotation in the markets and then focus on seasonality as we usually do at the end of the month in these videos. Let's start with a look at the current situation of sector rotation. I am recording this on Friday morning Eastern, and the RRG, the weekly RRG, is as you see it on the screen right now. And that will not change dramatically until the end of trading today. If you look at the tails and the rotations on the current RRG, you will see that 9 out of the 11 sectors are on a positive trajectory, meaning a positive RRG heading. And only 2 are on a negative heading. And the ones at a negative heading are technology, XLK, and consumer discretionary, XLY. And we know that those are the most important sectors from market capitalization perspective. So it means that all the others are sort of balancing out what's happening in technology and consumer discretionary. And with the market falling, and Friday, as I said, Friday morning I'm recording this, the S&P is down 1.8 and the Nasdaq's down 2.5%. Obviously that's going to hit XLK and XLY pretty severely. And because of the weight of those sectors, all the other sectors at a positive heading are not able to keep the S&P afloat. Also, the fact that they're at a positive heading doesn't necessarily mean that the prices for those sectors are going up. It's a relative thing. So if you look at, for example, energy or financials or communication services, which are the 3 sectors in green, they're the 3 inside the leading quadrant. Energy has just crossed into the leading quadrant. Financials has rotated back into it, and communication services as well. So these 2 are on the forefront of the sectors at the moment. But even though they are in the leading quadrant and on a positive heading, it doesn't necessarily mean that their prices are going up. It just means that their prices are going down less fast than, for example, technology and consumer discretionary or the S&P 500 in general. Let's take a look at how this goes and what it means if we break it down into offensive, defensive, and sensitive sectors. So if I look at the offensive sectors, and that's materials, real estate, financials, and consumer discretionary here at the bottom, then you can see that 3 out of 4 are at a positive heading. Only consumer discretionary is out of favor. And again, the problem is that this is such a large sector that it is actually dragging the market down. A similar thing, or even more opposite rotation, you will see in defensives, because healthcare, staples, and utilities are all on a positive heading and almost crossing over into the leading quadrant. And that leaves us with the sensitive sectors, the economically sensitive sectors. And there you will see that also technology is the only one rotating out of favor. The overall takeaway, at least the overall takeaway for me, is that obviously technology and discretionary are dragging the market lower. And the relative strength of all the other sectors is not enough at the moment to keep S&P, keep SPY at its current levels or push it higher. So that's a problem. How big of a problem? Let's look at the chart of SPY. This is the weekly SPY chart that I've been using in these videos for a long time. You'll see all my historical annotations. The first thing, and that happened a couple of weeks ago and we mentioned it here, was the completion of this double top formation. We had the initial decline that went to levels around 550 and then we bounced. And traditionally, all support becomes resistance, and the S&P seems to be respecting that rule, if you wish, quite well, because This week especially, we peaked around 576. And when I'm recording this, we're at the low end of the bar around 556. So that's a pretty decent reversal during the week. The first support level I am watching is that old rising resistance line of that old channel, which is coming in around 540. And it's sort of coinciding with the target, which I pegged there a couple of weeks ago already. When we completed that double top formation, you can project the height of that formation down, and that comes out around 534, 535, make it 540. So this area is the first area where we are going to expect support for SPY. If the market is able to bottom there, then that would be a good new buying opportunity, because if you look at the longer term picture, that whole secular uptrend is still there. We're just in the first meaningful decline, I'm going to say, since October 2022. So that is where we are in my mind in the longer term picture. When we move to the daily version of this chart, to the daily version of SPY, things are a little, well, they're obviously more granular. So here you see the double top magnified and the target magnified. That's the 540 area that we just talked about. But what's happening today, or what has been happening over the last couple of weeks, looks to be a flag pattern developing, a bearish flag pattern. And this is it's flag pattern happens when you have a large decline and you go against that decline, in which, you know, what would look like a flag, and then you break out to the downside. So this is almost a textbook flag pattern. The problem is that when you apply the rules for target setting based on flags, basically what it says is that you can project the decline from the breakout level. Now let's do that math. So we're around 610, a little higher, rounded off at 610 to 550. That's 60 points. And then we take it from the breakout level, which is 565 minus 60 is 505. And 505 is the bottom of that old channel. And you know my sort of go-to rule that when a market breaks out of a channel and then comes back into the channel, very often I see that market going to the bottom of that channel, to test the bottom of that channel. And that will coincide with that 500 level. So summarizing it based on the current sector rotation and the double top formation and the potential flag formation that we're seeing, I am watching the area around 540 as my first support area. When the market starts showing signs of bottoming out in that area, I think that would be a decent buying opportunity. But if that flag works out as it should according to the theory, we're watching a decline towards 500. If that happens, then the area around 500 and that rising support line, if the market starts to bottom there, that would be the next buying opportunity. So it's either 540 or around 500. Those are the two, I think, major areas that you need to watch in the S&P 500 for renewed buying opportunities. At the moment, given the current constellation of the sector rotation, as well as the status of the S&P 500 chart, I think that the upside potential is much less than the downward risk. And that is not a good ratio for entering new long positions. And as I mentioned at the start of this video, we're at the end of the month, and that means that we're usually looking at seasonal patterns across the sectors in the S&P 500. And that's an interesting exercise at the moment, I tell you, because we are supposedly entering a pretty strong period for the stock market. And let me try to highlight and filter out a few interesting as we're seeing them on the various seasonality charts. Now, to explain it, for those of you watching this for the first time, the bar chart here is current price, in this case of SPY. The candlestick chart here is the 20-year seasonality, the average of 20-year forward-looking prices for SPY. Obviously, that is biased upwards because we've had very strong markets. And then the chart at the bottom is the rate of change of that seasonality, of that seasonal pattern. That sort of magnifies and detrends that 20-year seasonal pattern. And if you look at the chart and compare it with what's currently going on, it looks as if the S&P has been behaving perfectly to the seasonal pattern. You can see that high that was set here mid-Feb, and then we go to a low, which is happening in the 10th of March, and we rallied again. And if you look at the rate of change, that is coinciding with a bottom, and we would expect a strong market for SPY. If I look at the current chart, which I just presented to you, I am not 100% convinced that this is going to happen. And that's the problem with looking at seasonals. You're looking at a theoretical, historical pattern that has developed. But let me just do a little bit of fantasizing forward looking. If we are going to see a continuation of this decline for the next couple of weeks, and we see that low coming in here, which is only 4 to 6 weeks after that seasonal expected low, and we're at the end of the year, we're all going to say, yeah, that was pretty close. But we have to decide now whether we are going to exploit that seasonal low or wait and see what's going to happen. And given the status of the S&P chart, I am in the camp where I'm going to say, let's wait and see what happens. I am not entirely sure that this seasonal low has actually played out already. In other words, is this low that we saw here the seasonal low based on the 20-year trend and the rate of change? I am not convinced. If we go through the various sectors, then I'm going to do this very quickly because it's loosely connected. There are a few that are showing an interesting pattern, but because the market as a whole is supposedly in a strong seasonal pattern, you will see a lot of sectors that have a seasonal pattern that looks like the one that we saw on SPY. So you would expect a rally or, a continuation of the rally. So we're not going to dive into all of these individually, but I'm going to highlight a few. And we're going to look at this one, which is price-based. And then for every sector, I have a chart which is based on relative strength, where we compare the seasonal relative strength with the actual relative strength. And that is a chart that looks like this. So here we have the seasonal pattern for materials. And this is what actually happened based on relative strength. And this is again, the rate of change of that seasonal pattern. And what you see here is that we actually went kind of in the opposite direction. Here, the real life seasonality was down from here, but the seasonal pattern was expected to be up. And now it's suspected to go down, but we're actually going up. So I'm not sure if this is any helpful indication. Here's communication services. That's a different story. This has been the leading sector for the better part of this year, and it is completely in line with what's happening on the seasonal pattern of relative strength. But if you look at the rate of change, it is sort of moving sideways. So it's been moving higher, but not with much rate of change. And if we are now here, then we are sort of, if you look at this, not much is happening in terms of rate of change, just a little blip up. And I think that is aligning with what we see in the communication services sector, which is kind of, losing a bit of relative strength. If we look at the relatives, then it becomes even more clear. Here is the rate of change moving sideways, and that is what we see. So from here to, and this is the end of the month, the end of April, and on here only a little bit up. Not much is happening with the relative strength for communication services. So communication services seems to be stalling from a relative perspective. And over the weekend, I'm going to write a new article on the best 5 sectors. And a sneak preview has told me that communication services seems to be losing its #1 position at the end of this week. We're not there yet, but it was the strongest sector for a long time, and it's now losing its top position. And that is reflected in this seasonality pattern, I believe. Here is the energy sector that jumped into the top 5 last week, and you see that it is in line with a rally, and here we also see a rally in terms of price. If we look at the seasonal version, then it looks like we took a little bit of a head start here, because from a seasonal perspective, the energy sector starts to outperform at the start of December and then moves up until roughly June. In the beginning with a lot of momentum and then not so much momentum. And you see that it looks like we were a little bit shifted, but we're in line with that relative improvement. So that sector seems to be aligning with its relative picture, and it's in the top 5, so that's a good sign. Here we see financials. Again, it looks like we're perfectly aligned with the bottom coming in now and moving higher. But more interesting, I'm more interested in the relative picture. And we see that financials are absolutely very, very strong. It seems to be moving to the top in the ranking at the end of this week. And from a seasonal perspective, we have a little bit more to go. So financials seem also aligning with their relative seasonal pattern. Here is industrials, bottoming out, rallying, price perspective. If you look at the relative seasonal, we're in a period, so it looks like we have a little bit more to go until the end of the month, until the end of April. Industrials are usually outperforming the S&P 500. Now, technology, obviously the driver of the market, and what we see here is that it is dropping like a stone, and that is what we expected from a price perspective. But when you look at the relative, we are actually pretty much in line with that rate of change, and we're looking ahead to more underperformance for technology, at least until the start of the month, May. And technology underperforming and under pressure will give SPY a hard time rising. So this is a pretty crucial sector from both a price perspective as well as a relative strength perspective. And quite frankly, it doesn't look good. And here is consumer staples. That is the reverse. You see an expected rally in terms of price, but also in terms of relative strength. You see that it looks, and this is the seasonal pattern, but look at the rate of change that magnifies those moves in terms of relative strength. And we have a little bit more to go until the 5th of May, the start of the month of May. So consumer staples expected to continue their outperformance at least for the month of April. And that is like literally opposite of what we just saw in technology. That's an interesting observation where defensive sectors have the seasonal outperformance over a sector like SPY. And that, although not everything is aligning perfectly, if you look at the bigger picture where the defensive sectors based on seasonality can be expected to outperform, and especially technology is expected to underperform, that matches with weakness in the S&P 500 going forward. Here is real estate. We look at real estate from a relative perspective. We have a little bit more upside to go. And if we look at utilities, you can see that it looks as if we kind of bottomed right spot on, and then we're looking for a little bit more price rises in the months to come. And here's also, we had this jump in relative performance, and we are moving higher and remaining at that level with momentum on the rise until the start of May. So utilities, another defensive sector with a positive outlook based on relative strength. Here is healthcare. Again, looks, as I said, a lot of these charts are bottoming right spot on with where they are expected to bottom based on seasonality. If we look at the relative seasonal, then this is where it becomes hard. This is where we had a peak. Seasonality was declining and expected to bottom out like right here. But healthcare did not do that. Healthcare only bottomed out 4 or 5 weeks after the fact. So the question now is, do we need to shift this bottom backward? And if this low in real life aligns with that low that we were expecting here, does that mean that we still have some time to go higher with healthcare? I'm inclined to say yes, because healthcare is also a defensive sector, and those defensive sectors seem to be on the rise. So I believe that this low here came late, and we have still a little bit more relative upside to expect from the healthcare sector. Here is consumer discretionary. Again, here's a bottom. We expect a rally based on price. And look at the seasonal pattern. This is very mumbo jumbo, very, very volatile. If you look at the reality, we peaked here and we're now moving lower. So are we late, or have we just started this and, do we have a little bit more to go? I really don't know. But the picture for consumer discretionary, the real picture, if you look at the RRG, for example, is not very promising for the weeks to come. And this is obviously a very offensive sector. Before we finish this video, I quickly want to go back to the current RRG, because I remember that I only showed you the weekly version. So here it is again, just for reference. If we switch that to a daily chart, if we switch that to a daily RRG, then you can see, for example, and this is the one that caught my eye, that the technology sector went through a little bit of an improvement. And if you remember that price chart where you broke and you rallied and we're now going down, that's what you see in relative strength as well. It's rolling over. And this is starting to reinforce that weak tail on the weekly RRG. Consumer discretionary is still on the rise, but if it follows the pattern of technology, if the daily tail of consumer discretionary starts to roll over next week, then that will be a reinforcement of that weakness in the weekly tail for consumer discretionary. On the positive side, you can see how communication services went through a little bit of a dip and is now rotating back into favor. It's moving back towards the leading quadrant. And as you know, that weekly tail for communication services still inside the leading quadrant, looking good. The same goes for financials. That is a strong tail moving into the leading quadrant. Energy is now rolling over, but on the weekly RRG, it's just crossing over into the leading quadrant. So all these sectors that are currently at the top of the list are reinforcing and confirming their positive outlook. Same for consumer staples, starting to curl back up. Utilities not yet. Healthcare just about. So the daily RRG, to a large degree, is confirming and starting to confirm the longer term rotations that we're seeing on the weekly RRG. So wrapping that up for this week, market under pressure, S&P 500 completed a double top, looking for 2 support areas, which are very important for the follow through when it happens. And from a sector rotational point of view, consumer discretionary and technology are dragging the market lower, and the combined forces of all the other sectors are not strong enough to keep the S&P at current levels or higher. Thank you for watching, and I'm hoping to see you again next week at a new RRG video.